Hello and welcome. This is Eric here, Mr. Fired Up Wealth. Today, I want to cover software as a service and give you my predictions, give you some information through some research about what software as a service stocks, what cloud stocks might do over the next decade. You know, we get that misconception, I think, a lot of times you hear it, that these SaaS stocks, these cloud stocks made a big run in 2020 because of the pandemic and there's not any room left to run. And that as soon as, everything goes back to normal, these companies won't be as valuable and we should just sell the stock now and buy something else. Well, I'm going to show you my perspective and some research that might actually show you otherwise. So there's no question that some of these stocks have made massive runs. They might be a little bit expensive in terms of valuation and things like that. But when you look at the total addressable market and you look at the growth over the next 9-10 years, in this decade, 2020, we're in 2021 now. What are we going to do in terms of, what's going to happen to this industry between now and 2021 to 2030? That's what we're going to show you today. Also going to cover, of course, should you invest in cloud stocks? And then I think this will be a favorite. I'm going to show you a chart that shows the top performing software as a service IPOs of all time. And you're going to want to see that. It's later on in the video, so definitely stay tuned to check that out. If you have not subscribed to the channel, please do hit the subscribe button, hit the like button, comment, give me a comment, share the video. This channel is really about trying to outperform the market, trying to grow your wealth as fast as you can and enjoy life, early retirement, and eventually live off dividends through passive income. But that's for another video. So let's get into this one. So software as a service. Okay, what is SaaS? SaaS, software as a service. It's described as software deployed in the cloud and billed on a subscription basis. We're talking about recurring revenue, okay? Compared to traditional on-prem software. So if you hear on-prem or on-premise, that just means software that you typically install and you house in a server at your location. So that's on-prem, where the old school methodology where you might implement SAP or PeopleSoft or whatever ERP system, enterprise resource planning ERP. And it's not just ERP, but when you think of the old on-prem, it's generally, ERP software like PeopleSoft, what have you. And that's actually taking software and installing it into servers and the databases that you own, that you house, that you maintain on your property or on premise, okay? So compared to traditional on-premise software, software as a service provides customers with a number of benefits, such as SaaS eliminates the need to procure and manage hardware. You don't need to buy servers anymore. That's a huge cost and it can be a real pain. You have to have staff to maintain that, things like that. It's accessible anywhere, which because of the pandemic, we now know is more important than ever. And it's not even the work from home economy, it's work from anywhere. And I think you're going to see that adoption carry through even as the pandemic, improves. You're going to see people that are going to have the ability to work more of a flex schedule, maybe a combination of at office or from home or from anywhere. People are going to have this thirst, this desire to travel. And when they're able to do that, the people that have, those type of jobs that can work remotely, I mean, there's no doubt that there's going to be people that, will be going to Hawaii and working from Hawaii for a few weeks and things like that, especially the younger generations that don't have kids. Trust me, it's going to happen. Requires minimal maintenance, autonomous updates, meaning it can just get updated in the cloud or at the data center, and that you don't have to have a DBA, database administrator, or anybody that's part of your tech team on site, that have to update that software all the time. Patching and updates, my background, if you're not familiar with me, I worked in software. I worked for Oracle. I sold Oracle software. I also sold the services, so consulting service, implementation services, training, things like that. And that is a big pain. You think of patching, or PeopleSoft, new tools, upgrade from 8.5.5 to 8.5.6 to 8.5.7. There's constantly patching. When you do it through a software as a service, that's part of the subscription. You're paying for that autonomous update and you don't have to worry about it. You just are a user of the software, an end user. SaaS is subscription based with low upfront costs, which is an operating expense instead of a capital expense. Why is that important and what does it mean? So an operating expense, when you think of an operating expense, it's something that you pay maybe monthly or even annually, but you can generally recognize it, within quarters. There's different accounting practices for it, but instead of one lump fee all up front as a capital expense for accounting purposes, you can use it as an operating expense and spread it out over a duration of time. It's very handy for businesses, for CEOs, for business owners to be able to do that. And it does help with that cash flow. And it's important as, you know, as a business owner or as a company, you want to have that cash flow. And SaaS is easy to use with minimal training. Why do companies love it? So when I say why do companies love it, I'm talking about so every customer uses the same software. So I'm talking about why companies love it. I'm not talking about the businesses that are buying software as a service, the end users, what have you. Why companies love it in terms of why a business would build a software as a service platform. So why does Salesforce love it? You know, why as a business, if I'm creating software as a service, why do I love it? Every customer uses the same software, which lowers the cost and complexity. It's about economies of scale. Subscriptions generate predictable recurring revenue with automatic renewals. This translates to higher valuations on SaaS stocks versus traditional software stocks. Why? Because you have insight, you have visibility into what the growth, what the revenue is going to be in the future. It's instead of big peaks and valleys with sales, it's very consistent, and it's easy for Wall Street, easy for investors to have an idea, to have insight, to understand what the growth trajectory is when you look at things like annual recurring revenue and what have you. By leveraging the public cloud, SaaS companies can serve software to customers directly, which allows clients to not need their own data centers or prep their own environments. That's what's great for the users of SaaS software is they don't have to have their own data centers. They don't have to buy their own servers, have to have IT staff to maintain and to patch, things like that. And SaaS vendors, software as a service vendors, own each customer relationship. So this allows full insight into client usage patterns and payments, which enables upselling and cross-selling. And this is why certain companies like Salesforce can do a great job when they acquire different businesses, because they're able to cross-sell that into their sales organization, and they have a very good sales organization. And so when you think of Salesforce, oh no, they're buying Slack, don't buy the stock, you know, it's scary, it's too much money, they're overpaying for it. You know, I have a feeling in a couple of years, they're going to look back at it and say, well, that was a really smart move, because they've proved themselves to us time and time again. And I have faith that the management team is going to do the same thing, you know, with this acquisition as well. Do we have oversaturation? Because that's something, if you don't understand the industry and you didn't come from the industry like I do selling into it, you might just hear stuff on TV from analysts or from people that maybe don't really understand the industry as well as they should to be talking about it. And that's unfortunately a pretty common thing that we have to deal with as investors, right? So the thing about oversaturation is that there's unique business models that explain why there's so many enterprise software companies. It dwarfs the numbers of consumer tech companies. So what do I mean by that? With a few exceptions, consumer tech companies don't make the products they sell. So Facebook, for example, aggregates user-generated content. Zillow Group, you know, ZG or Z stock, the existing housing supply, and Uber, independent drivers. You know, they're basically connecting independent drivers with people that want to ride share, right? Grubhub, existing restaurants, you know, DoorDash, same kind of thing. None of these companies make the products they're selling, okay? Natural winners emerge because of network effects, which make competition difficult. So let me clarify what I mean here on the next slide. So here's a nice little NASCAR slide, all the different stocks or companies that you might be interested in. I own a lot of these actually. So if you look at DataDog, it's one that I picked as like one of my top 5 for 2021 and beyond. And I produced that video back in November, and it's done well since then, as well as stocks like CrowdStrike on there. If you haven't checked that video out, check it out. I'll put a link up above and you can take a look at that. But there's some great ones in here. Blackline, I did a video on that one, and it's done nicely since then. Cloudflare, Fastly, Paycom I do have in the portfolio. Paylocity I have in the portfolio. RingCentral, Shopify, ServiceNow, TWLO. Just did a video a couple weeks ago on TWLO, comparing TWLO and bandwidth. So check that video out. Again, subscribe if you haven't, because if this is interesting to you, this channel will be your cup of tea. But there's some great ones on here, some that I don't own as well. So oversaturation. Enterprise tech is different. Enterprise technology companies are not resellers of existing products and services. Almost all create and sell new products. they're not aggregating public information or content. So a lot of people always ask me, why don't you own Facebook, or why don't you own this and that? It's not that I don't think Facebook's a good company. It literally prints money. You know, there's a lot of drama around it and political risk, but they're different. You know, it's not enterprise technology companies. These guys are creating enterprise. So I said earlier in the beginning of the video, ERP, that's enterprise resource planning, but now it's just enterprise technology because it can do, you know, CRM, which is customer relationship management. You can do HCM, which is human capital management, you know, supply chain management. So it's, you know, there's on and on and on. You know, there's even for universities, there's a thing called campus solutions. There's lots of different products that can help these customers with their different needs. Okay, so here's another nice little NASCAR slide. So let's see. I actually own all of these stocks. The bottom two asterisks on those two. So Palantir did a video on that one. I think was the first YouTuber that did Palantir video. We've all crushed it on that one, buying it at 9. You know, Snowflake, I do have some of that. It obviously is really expensive and it's hard to just go all in on it right now. So I've been dollar cost averaging and I've got not as many shares as I'd like, but I do have some Snowflake. Datadog, you know, one of the top holdings, CrowdStrike. Elastic's one, I did a video on Phaser, which is Fastly, Appian. Z is for Zoom, E is for Elastic, and R is for Roku. Slack, I don't technically own the stock, but I have one of my larger holdings in my portfolio is Salesforce CRM, which is acquiring Slack. And Zoom is one that I actually really wish I would have grabbed at like 315, 320 bucks. It's now run to 390. It has some amazing growth metrics. And I'm considering doing a series of SaaS videos. It really is my specialty. And, you know, I've got a lot of information that I could share with you. I can make this video 3 hours long. Instead of doing that, I'm making this video concise, trying to give you some good information. If it's well received on YouTube, I'm considering making some more videos. But Zoom, I don't own directly right now. I have a bunch of WCLD ETF, which owns Zoom, and I have a couple other ETFs that have Zoom. So anyway, so oversaturation. So since every new software generally maps to a single product among thousands in the $3.7 trillion IT industry, the market has supported thousands of enterprise software startups, giving rise to a large and growing number of public SaaS companies. So you think, well, you know, if you don't know what these companies do, there's a lot of confusion. Like, well, these guys all kind of do the same thing. It's like, no, they're all completely different. You know, you can look at every one of these logos on your screen and they're completely different. Some of them have, you know, overlapping products that compete with each other. Some of them actually partner together, but they're all very different companies. And there's hundreds of different stocks that I follow. And some of them do similar things. Some of them are competitors, but a lot of them actually have very unique niches within, you know, software as a service. So it's a very, very interesting space. You know, you could focus all of your energy just trying to master, you know, software as a service. And I think you could spend, you know, quite a bit of your time just in that space, not even going outside of it. So that really is my specialty. It's majority of my assets are in software and software as a service type companies. So anyway, hopefully this is helpful. Let's dig into it a little bit more. Okay, let's get into some of the good stuff, right? So this here, I actually did some research and there's an ARK white paper. I'll share that link with you in the description of the video. But on figure 3 of that white paper, they talk about consumer tech versus enterprise software IPOs. So in the last couple of slides, we were talking about kind of the difference. And you know, my focus is really going to be on enterprise software, especially software as a service, or companies that are traditionally on-prem that are trying to move more to a software as a service model, like a Splunk is a good example. You know, Adobe did an amazing job of that. That's really the, you know, if I were doing a case study on the best, you know, transition that you possibly could have within the space, it's probably Adobe. And Autodesk is trying to do something similar right now, but anyway, I digress. So if you look at this, these green X's are going to be enterprise software. There's 96 companies, right? And the average CAGR is 50%. The median is 23%. Now compare that to consumer tech. There's 24 companies. Now again, this is IPOs 2008 to 2019 in US, so it doesn't include 2020, unfortunately, because it would actually probably even skew these numbers even more. But on the consumer tech side, that's the purple X's. There's 24 companies. The average CAGR is 13%. The median is actually only 8%. So big difference. You can see, way up on the top here, you've got, 300 and 400% in between, that range. You've got, 2X's, one just below it, close to 300%. The highest purple that you see is just over 100%. And there's, there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 11 or 12 of those green X's actually above the purple. So that's a big deal. It's something to keep in mind as an investor. Okay, so multiple returns since IPOs. Now, asterisks on this, right? So this is market data as of January 8th, 2021. So it's pretty recent market data, but it does exclude companies that have gone public in the last 6 months. But it gives you an idea of performance, up until basically mid 2020, which still gives you a pretty good snapshot of what's happened over the years. And you'll see on the far left, that's Salesforce CRM. That's given if you invested this on the IPO, and it's been around a lot longer than these other companies. So there is that, of course. So keep in mind that Salesforce has been around a lot longer than the rest of these companies, but 80.7x return since IPO. Shopify is even more impressive because it's giving you almost a 70x, and it's not nearly as old. Next is Ring Central. That's one of the Fired Up Wealth favorites. ServiceNow, which I've had for many years. I had an amazing return on that stock. Paycom I have in the portfolio. There's Five9. There's Twilio. I've got Twilio, Coupa Software, Zendesk, HubSpot, Wix, MongoDB, OTKA. There's Viva, Zscaler, Paylocity. Team is in there. Zoom, DocuSign. You can see all the way across. On the far right, you see ZUO is at only a 1x. And you start going to the left, you see DBX, you see Sumo, you see Box, PS, Frog. Frog's only at 1.4x. Workers at 1.6x. PagerDuty's at 1.9x. But, you could look at this and say, wow, Snowflake's only given a 2.5x. It's a little deceiving because if you would have got in on the IPO, of course, it's a much bigger return than that. But anyway, this is just to give you an idea of some of these stocks. Blackline's in here, Workday. There's CrowdStrike here is at 6.6x, Fastly, Cloudflare. But these aren't that old, so these are 2019 IPOs. So CrowdStrike, Fastly, and Cloudflare, I'm pretty sure all three of those were 2019 IPOs. It's been a year, 2 years, and you've got a 600 and 600%, 500% return, and so on. So really good returns in this space. I still think there's a lot of room. I'm gonna explain why here in the next couple of slides. So why is SaaS different now? What does that even mean? Well, it's been around for 15 years. It's not like SaaS technology is new. It's been around for a while. But SaaS today is benefiting from 5 characteristics that have evolved over the past 5 years and that were really amplified and expedited during the recent pandemic. So the decentralization of IT purchasing is number one. Of course, the way IT purchasing, it's changed a lot. So I used to have to actually work with procurement and IT purchasing. And I can tell you that even in the last couple of years, it's changed quite a bit. It's a lot simpler for some of the organizations to get things done. It used to be much more complex. Now, if you look in the federal space or if you look at the government space, it's still, not the most efficient approach, but overall, we have had a decentralization of IT purchasing. Number 2, new platforms have attracted not only companies, but also individual departments, expanding the total available market or the total addressable market. The emergence of high margin self-service, as well as viral sales models. The incorporation and the adoption of AI, artificial intelligence, which differentiates vendor offerings, and that's becoming more and more important as we move forward. Accelerated investments in remote work, as we talked about earlier, in response to the coronavirus pandemic of 2020. Okay, so this is a really cool one too. This is from that ARK white paper. So this is on-prem versus cloud compute infrastructure, total cost of ownership for 100 servers over a 3-year period. You can see it's pretty self-explanatory, but on the top is on-prem. So you have a pretty substantial server cost, and you also have storage, you also have network, and you have labor. Look at the difference. So you're looking at almost 900,000 on the on-prem, and cloud is less than 300,000. So that's really significant. And I can tell you, as someone that used to sell multi-million-dollar packages to executives and CIOs, This is very powerful, not only the way that CapEx works, but also just the total cost of ownership. And the nice thing about a company, if you're a business that's selling SaaS, you like it because you're getting more piece of the pie. So in other words, if I'm a software as a service vendor and I don't sell, servers, right? I'm getting a bigger piece of the pie on the cloud subscription revenue than if I'm just selling on-prem software. So I can actually charge more, and I can, essentially be more profitable as a SaaS vendor because I can get more piece of the pie. It's less expensive for the customer, overall ownership, but you're getting more money still. I mean, say you're a legacy type company like a Splunk, where you're trying to grow more into the cloud side of the business versus like a CrowdStrike or Datadog that was, built in the cloud for the cloud. It's a lot different, right? So these guys, like Splunk is just an example. There's several of them. They still do on-prem software, and they're doing more and more cloud, and they're trying to convert more of their customers into cloud. Let's just use an example. Let's say that they were using on-prem, so they were doing on-prem. Now, the customer might have a big expense to say Oracle for servers, for databases, to basically have on-prem databases. They might have implementation costs, labor, all this stuff, right? If you're now Splunk and you're doing it as a recurring revenue model, as a cloud model, they're actually going to be able to charge more, especially over a period of time, for the same software, but it's giving advantages, a lot of advantages to the end customer, not only with the CapEx as we mentioned, but also just ease of use, simplification, autonomous updates, all those different things. So it's a very strong selling point if you're selling to an executive, a CIO, a CEO, and I'm selling software and I'm selling cloud software, trying to get you to switch from on-prem to cloud. I've got a lot of ammunition in my pocket. And I don't even, depending on the company, it might not even be true SaaS. It could be infrastructure as a service or platform as a service. So you hear of IaaS and PaaS. So there's a lot of opportunity to move customers from that on-prem model to that cloud model. Okay, so what are some top SaaS trends to keep an eye out in 2021 and beyond? Now, this is just a quick, demonstration here. There's tons of other ones, but I thought this was a good list. This is the top 10 SaaS trends, and it's off of a blog. You can see the link down here if you want to check out that blog. So mobile optimization, obviously really important. People want to be on the go. They want to work from anywhere. We talked about earlier, artificial intelligence. We mentioned earlier, AI. The growing need for API connections. If you're not familiar with APIs, that's application programming interface. And it's software that allows two applications to talk to each other. It's as simple as that. So it could be something like, making your ERP software communicate with your CRM software. So it could be, it could be something like CrowdStrike and Datadog actually partnering together and having APIs for them to communicate, or, what have you. That's just an example. But each time you use an app like Facebook, for an example, if you send an instant message, use Facebook, check the weather on your phone, et cetera, you're actually using APIs. But there's different ways to look at APIs, but that's the most simplistic, form to kind of look at it. Low code optimization. There's certain stocks that kind of play on that trend too. Like you think of Appian, that's what Appian's all about, is that low code optimization, so that you can take people that aren't maybe expert coders and make them a little bit better. And there's always going to be drama and maybe debate on if that's the best approach or not. But there's no question that machine learning and the AI, that's slowly going to improve that low code optimization over time. It's just a fact. It's part of reality. It's part of something that we need to get used to, because it's certainly going to keep continuing to happen. Machine learning, we kind of mentioned there, migration to PaaS, that's platform as a service. Micro SaaS, small side. Centralized analytics, this is real big. Another reason I like Salesforce CRM, you think of TWLO, it allows them to have that centralized analytics piece of their business. White label SaaS. So what white label SaaS really is if you're a business that's a software company, you can create a SaaS application that you can resell to somebody else that vendor then can turn around and sell again and customize. So that's what white label SaaS is. It's becoming a little bit more popular. And then vertical SaaS, just thinking about all the different parts of the box, all the way up to spectrum, vertically with software as a service. ARK research highlights from the white paper. And this is a pretty long white paper. I encourage you to read it. I might do some more videos and incorporate some of the data, because there's some good data in there. But the highlights, this is really the most important part. at least in terms of what I'm trying to demonstrate today in a quick video. In 2019, SaaS companies generated about $100 billion in revenue and accounted for 25% of the enterprise software market. So we expect, when they say we, it's ARK, we expect SaaS revenue to grow 21% at a compounded annual growth rate. That's CAGR I mentioned earlier. So anytime you see CAGR, that's compounded annual growth rate until 2030. So again, I'm going to read that again. We expect SaaS revenue to grow 21% at a compounded annual growth rate until 2030, reaching $780 billion or 81% of the enterprise software market. So ARK is saying that right now you have 25% of the enterprise software market being SaaS, and they see it going in the next 10 years from 25% to 81%. So I'm not a mathematician, but I can tell you that means there's a lot of room left, a lot of run rate left, and that we're still in the early innings. Enterprise software companies are going public at a much faster rate than consumer technology companies, and they're in more demand from investors. I can tell you that much, and you saw some proof of that earlier. Between 2009 and 2019, 98 enterprise software companies went public, quadruple the 24 consumer tech IPOs. Nearly 80% of enterprise software IPOs were SaaS companies. That's a big deal, 80%. During the same 10 years, enterprise software IPOs returned nearly 23% at a compound annual rate, nearly triple the 8% delivered by consumer tech IPOs. My money is going to be on these SaaS plays because it's proven to work, and we know there's room to run. SaaS companies increasingly have employed viral and self-serve customer acquisition strategies, improving their sales efficiency almost threefold, and enabling not only rapid growth, but also positive cash flows, according to our search. That's the thing about a lot of these companies. They're growing massively, but a lot of them are actually getting profitable faster than most people would have thought. Datadog, amazing growth. Go look at Datadog's growth, year-over-year growth, just their revenue growth, and look at the last 3 quarters, and look at the profitability. Look at the net profit margin. The net profit margin actually is positive. So they have this amazing growth rate with a positive net margin. So when you do a rule of 40, right, you're going to add that revenue growth, with that net profit margin, and you want, so if you have, say, 60% on the revenue growth and you have negative 20% on the net profit margin, that's still 40. You say, well, it's a rule of 40. So the company's doing all right based on SaaS, right? That's how one of the tools that you use to analyze a software as a service company. You look at something like a Datadog, they've got amazing growth, and now they're actually, breaking even slightly positive on that net profit margin. That's pretty amazing. There's more and more companies that are like that are fitting that model. You look at like Salesforce, you look at Adobe, they're actually have decent growth, but they have really solid profit margins too, making them a mature type, rule of 40 company where you're getting actually more from the margin in some cases than you are from the growth, but it's still very attractive as an investor. I've got the camera off so you can see this whole chart. Predictions. This is another chart here from ARK Investment Management LLC, and they actually used Gartner data for that. Forecasts are inherently limited and cannot be relied upon. So it's saying that these aren't guaranteed, of course, but they do a pretty good job with this stuff. And I thought it was good just to kind of show you guys what they're thinking. So on the left-hand side, industry forecast for non-SaaS. On the right-hand side, check it out. So shows you 2017 to 2030. So if you look at 2020, it shows 150 billion in the purple, which is SaaS, and that red is non-SaaS, 340 billion, that red box above it, right? Now, if you follow that CAGR, 21%, and you draw a line, we're basically at the beginning of 2021, right? So you look at that line, basically 2021, if you were to invest in this industry, in the SaaS software market right now, beginning of 2021, according to ARK Investment Management Research, if you follow that line, you have 780 billion at the very end in 2030. So it's going to go from 150 billion on the SaaS to 780 billion. That's a big, big number over 10 years. And on the top, only 180 billion. So non-SaaS is saying is going to shrink. It's actually going to compress from 340 billion in 2020. And in 10 years, in 2030, it's going to be 180 billion. That is huge, guys. And that shows you that we are still in the early innings of this curve. I'm back for the final slide, predictions. So let's just go through this real quick. So these are a combination of my predictions and ARK predictions. SaaS's present penetration of only 25% we talked about suggests there's quite a bit of runway left for growth. Some people might be surprised by that because they think, oh, well, everybody already has it. So why would I invest in that? I'm going to go invest in, clean energy, this and that. And I'm not saying you should invest in those spaces, but I think if you look at the performance of SaaS, a lot of people are selling off their stocks thinking that it's already made this run and that there's no value left in these stocks. And I think that's wrong. I think some of them are expensive, but they are going to grow in their valuation. So when these things are on sale and they get beat up, like when Zoom was down at 315, that's when we should be nibbling on these stocks. And I should have been buying Zoom when it was in that range. And I didn't. I'm still watching it very closely. I've got a whole list. If you're interested in what I buy and sell, you can follow my portfolio on Discord. And if you don't know anything about me, I manage a multi-million-dollar portfolio. I've got an individual taxable brokerage that I actually, share the holdings. I share when I buy, when I sell. It's for educational purposes. I'm not a financial advisor, but you can join Patreon. I've got private content like a masterclass in there. We do daily live streams in there. We've got a Discord with like 35 different channels. There's all kinds of great information, great investors in there. There's 250 investors in there. And you can follow what I buy and what I sell right in Discord. So every time I buy a stock, every time I sell a stock, exactly within seconds after I make that move in that portfolio, what I paid for it, why I'm buying it, why I'm selling it, etc. And again, that's for educational purposes. And I think the people will tell you that are in it that have learned a lot. They've learned a lot just from seeing how I buy and sell. And obviously there's been some good picks in there, as well. And a lot of them have been SaaS related picks, but it's not just SaaS. There's plenty of other information outside of SaaS, and especially in the other channels as well. We've got some great channels, one for EV. We've got, separate channels for cloud. We got separate channels for cryptocurrency. We have separate channels for, MJ stocks, on and on and on. So anyway, I digress. Let me finish up with these predictions. So during the next 10 years, the SaaS industry, as we showed earlier, will grow 21% at a compound annual growth rate, generating $780 billion in revenue by 2030. Software will drive global productivity during the next few decades. So it's not over yet. The next few decades, software is going to drive global productivity. I want to be part of that as an investor. SaaS companies may be well positioned to capture a significant portion of future technology revenues. Yes, I think so. This is a quote from ARK. Great investment themes take years, if not decades, to grow from ideas to lasting secular industries. Pioneered more than a decade ago, SaaS has attracted mass market demand just in the last few years. With companies of all sizes adopting new digital workflows, the coming decade could prove to be the golden age for SaaS. I love it. I agree. So believe it or not, we're in the earlier innings, and some of these stocks are expensive, but they're probably going to go higher. And if you like to follow these type of stocks, there's a ton of videos already on Fired Up Wealth that talk about, stocks like CrowdStrike and Datadog and, Splunk and Salesforce and Adobe and on and on and on and on, Fastly, Cloudflare. But anyways, it's not all about SaaS. Of course, we cover lots of other things in the disruptive technology space. I could go on and on and on. I do also have dividend growth investing in my portfolio. I like to outperform the market, take the profits, buy blue chip dividend stocks, use that for early retirement. Please subscribe to the channel, drop a like, drop a comment, stop by Facebook. We have a private group. Stop by Patreon. If you're interested, sign up for Patreon, join our Discord, check out the masterclass. I appreciate your time and attention. I hope you have a great rest of your day. Take care.